The company we're going to talk about today is pretty controversial. It has quite a history, and probably skewed more towards the negative side. I think maybe a lot of European listeners may be aware of this, and maybe a little less familiar to the U.S. side. But Metro Bank is what we're going to talk about. This is a specialty situation, UK financial, just sort of level set. This is roughly about a 16.5 billion asset bank. The market cap of the company is, give or take, around 850 million pounds. It's listed in the UK. And I'm going to just talk a little briefly about the history of Metro Bank. And so Metro was founded by Vernon Hill, and for U.S. listeners, probably anybody focused on financials probably heard about Commerce Bank's success in the U.S. and think about banks open on weekends, open late. You had coin counters, back in the day. Your dogs can roam freely within the bank, and they referred to the banks as stores, and they talked about same store type sales, and it was a customer centric model. But it was the big benefit of the model for Commerce Bank was generating low cost deposits, which is sort of the lifeblood of a successful bank. So the idea with Metro was they were bringing this customer-centric focused idea to the UK, and it was the first, as I sort of said when it was founded, it was the first bank, a high street bank, to come in about 150 years. And so this is a big deal when it came in. And again, this was anathema to the experience in London, in the UK. I was in London for 2 years, and just anecdotally, I could tell you that even relative to the U.S., it was quite an experience. Even working in London, a lot of times you'd have to exchange your pounds for dollars, and I felt like it was almost like setting up a specialist doctor appointment to get an appointment with the UK bank in order to do a relatively simple transaction. And this was the experience for a lot of people within the UK. And so this idea resonated well. When Metro went public, I had first looked at been aware of this story, and it was, I won't name names, but there's some very high profile growth investors who came into Metro Bank and were investing at very high valuations. And it looked like, you had a, competitive advantage and, a really fantastic growth story here. So it went wrong relatively quickly, and so sort of the I guess the first place to start was in 2019. They had essentially, I don't want to call it an Excel error because it wasn't done on Excel, but what happened was they mischaracterized the amount of the risk weighting of the assets, and so we're going to be talking about like risk weightings and capital densities. And again, for the non-financial listener to this presentation, think about it as like, the idea for a bank is you set capital against risk-weighted assets, and $1 of treasury bills may have 0% density, and therefore you don't have to set capital against it. $1 of naked commercial real estate exposure could have a 100% density, and so that $1 of assets is $1 of risk-weighted assets, and we set capital against that risk-weighted assets. What Metro did was they misstated exactly the risk weighting against their commercial exposure, and so it turned out that they had a shortage of capital relative to the amount of assets that they had. The stock plunged, multiple plunges in 2019. They had to do a shotgun bond offering and then a shotgun equity offering, and they were essentially reeling from this from 2019 onward. Metro's approach post the crisis was essentially they were at a capital shortfall. They had to invest a bunch of money to bring in consultants, to have more internal controls, more folks to sort of make sure you don't have another capital error. It ended up costing the management team of the bank, and actually it was believe it or not, it was an MOI connection that helped bring in Dan Frumkin, who's the current CEO of Metro Bank. And his philosophy was, they initially bulked up in consumer loans. They were working on getting, and I apologize for the number of acronyms, but it kind of goes part and parcel with financials. Dan spent a lot of work on trying to get the bank for something called AIRB, which is Advanced Internal Ratings-Based models. And so think about it this way: we describe the risk-weighting assets, at a high level. For a standardized, so without these more advanced models, a mortgage loan would have a 35% density. So your $1 mortgage assets has risk-weighted assets of 35 cents. Well, if you get internal ratings approved, then that can drop 10 percentage points initially. Some of the larger high street banks operate at maybe 1/3 that level, and so there was a huge competitive advantage for the existing high street banks who had models for the same loans, same basic risk parameters, but they had significantly lower densities, and therefore the returns were much higher. So the approach for Metro Bank was, let's get approval for this. And it was just a painstaking process. The regulator sort of strung Metro along every indication that they were going to get approval. Metro was operating within the buffers of a capital ratio. And then in September of 2023, they find out that they're far off from AIRB approval. They're not going to get it. The stock price tanks again. There was limited deposit outflow. And then in a weekend, essentially, the Bank of England decides that they have to either raise capital to come into compliance, or the bank was going to be sold. And so that was done in the late fall of 2023. And we'll talk about the investor who led this fundraising. But it's quite a mouthful to go through. So you had a couple of near-death experiences. And, I think one of the questions usually is, well, why does this opportunity with Metro exist? Well, before that 2019 accounting crisis, Metro's stock traded above 22 pounds, trades at 125 now. So, typically, akin to, and the amount of dilution is staggering. I mean, there's 97 million shares outstanding prior to the 2019 crisis. The shotgun equity offering raised that to 172 million. And then in 2023, on the recapitalization, there's 673 million shares outstanding. So just sort of repeating that share count, share price going from 22 pounds down well over 90%. You can think about it again from, if it's a U.S. investor, perspective. If you were an investor in Citigroup or, Bank of America in 2007, you're not necessarily interested in hearing about how cheap the stock is, 5 to 10 years later. I mean, it's just the thesis you had. It went awry. It's a totally different investor base that came in. So from here, you can sort of understand this is, so this is a name that has burned a lot of investors. A lot of people are not looking at this at all. It's not well followed of any kind. The story is actually, I think, very attractive now. So what happened post the 2023 experience? Well, Metro Bank has drastically slashed its employee base. It's roughly 40% of the employees have been cut. The generating substantial operational savings. And the idea is, instead of they're not pursuing the AIRB model distinction, they're making a pivot towards commercial loan originations as well as specialty mortgages. And think about these as sort of like folks who are self-employed, something that's other than might even be equivalent to something like an Alt-A mortgage from back in the day. From it's not sort of a subprime, but it's a more complicated mortgage origination. And they think they can achieve strong spreads from these originations. And they sold their consumer portfolio. They sold a big chunk of their residual mortgage portfolio. And the residual mortgage portfolio is going to run off, and then they're going to originate specialty mortgages. Most of the loan growth is going to be driven by the commercial originations, and there's some positive signs on both fronts. Jaime Jelinski Bascal is the head of Spaldi Investments. He's had a couple of huge wins. This is the territory that he typically swims in, is sort of distressed financial investments. He was an existing investor in Metro when this happened. He came in, originally in the 2019 accounting scandal, and in 2023 he was the one who led the recapitalization. So Spaldi owns over 50% of Metro Bank. So in addition to being sort of a small cap specialty financial with a checkered history, you're actually investing in a minority float. And, so again, you can sort of talk about the number of folks who can look at an investment like this is somewhat limited. I would just sort of say, I think we're economically aligned with him. He's successfully sold banks in the past. I think it's distinctly possible Metro's sold. We'll sort of talk about, there was actually acquisition rumors in 2025 and it's sort of noteworthy that Spaldi bought another 500,000 shares at 120, so around current prices in December of 2025. So Dan Frumkin, I've spoken with him several times. He has sort of a background, again, working with restructured banks who have needed fixing coming in. I'd sort of say you could knock down a little bit for the performance for maybe a little too optimistic that they were going to get the AIRB approval. I think you give them very high marks though for slashing the operating costs, and that's not an easy thing to be CEO of a company that ends up slashing 40% of your workforce, especially in Europe. I would point out again, there's probably a lot of MOI ideas about UK companies in general. They screen cheaply. We're going to talk about the macro problems at the end of this presentation. One thing that does probably set Metro apart, I would think, in addition, in relation to other, quote unquote, cheap UK situations, is there is a pretty strong management incentive plan in place. So it's, put in place with the backing, obviously, of Spaldi, but he receives the compensation Dan receives is, the shares initially, again, 125 stock price right now. They were, the original equity was struck around 80 pence. You have to hit at least 120 for this thing to vest, and the payments go up over time with the stock price. And Dan can personally earn 60 million pounds if the stock was to hit 437 from 125. And so we'll talk about, there is actually a very credible bull case where that compensation target can come into play. So here was sort of, I mentioned the secret sauce for Metro Bank is the deposit franchise, which is fantastic. Again, banks open 7 days a week. The hours are not quite as extensive as they were prior to 2023 as part of the cost-cutting program. Slightly shorter hours, but it's still it's far superior branch network, hours open than any other UK high street bank. And the proof is in just the amount of low cost deposits that they have. The base rate, think of it, essentially the UK Fed funds rate is currently at 3.75 now. The exit cost of Metro Bank deposits was 95 bips. That's September of 2025. And as you can sort of see here, over 40% are non-interest bearing deposits for Metro Bank. And that's more than double the UK average. And so this is really, I think, a core competitive advantage of Metro Bank, and sort of makes this very unique among really European banks, and specifically in the UK. And so this is the competitive advantage to sort of most keep in mind. I sort of alluded to what the transformational strategy of Metro Bank is, and again, it's recycling these deposits that were the consumer portfolio has been sold. They're going to move from, and a big chunk of the residual residential mortgages has been sold. And you're going to move into commercial loans. And again, the idea is to originate it at least 350 bips over the base rates. And for the specialty mortgages, you're going to originate at least over 200 bips over swaps, and that's probably double and often more than double the spread that you get for plain vanilla mortgage. And so this is, as we'll sort of see, I mean, this is the part there's been really solid progress on this right away. In the first half of 2025, the last results, you had $1 billion in new corporate lending, that's double the levels, from a year ago. And you have a pipeline that is incredibly strong. So if you're looking at early signs of success, it seems to be working. The bar chart sort of shows the projected transformation of what their loan portfolio is going to look like, and they're aiming for commercial loans to equal roughly 70% of the book out a couple of years. And again, they've been swimming in deposits. When Metro was operating within the capital buffers of MREL, which I'll talk a little bit further about, they had to constrain their loan growth. And so the problem with Metro in the past was never, can they generate loans? The bank with its deposit franchise, the number of relationships it has tremendous potential to generate loans. It just didn't have the capital headroom in order to do that, and it certainly does now. Metro claims they have a relationship with 1 in 15 small and medium enterprises. They have a large number of corporations who have and small businesses who have deposits with Metro, have current accounts with Metro. Current account is essentially like, think about it as a non-interest bearing checking account. And it's just sort of capitalizing on this growth. And I'll talk about the second part in the next couple slides. Separate from this asset rotation, Metro has a large slug of essentially treasury securities that were at sort of low barely positive rates that are going to be rolled over into into rates closer to what the current base rate is in the UK. And this is an enormous uplift, and this is cumulatively it's going to be over 600 basis points. And again, from a current mid-single digit ROE at the first half of 2025, this is sort of like unless there is some radical change in the interest rate environment in the next 18 months, this drives a big chunk of the return. So, one of the pushbacks a little bit on the Metro strategy, well, if it's that easy in order to pick up yield, just moving from, residential rates to commercial rates, why doesn't every bank do this? And sort of one of the just answers is, again, this is a small bank, it's roughly 16-ish to 17 billion in total assets. And, you couldn't reposition a bank to commercial loans, primarily commercial loans from scratch, if you had a bank of hundreds of billions in total asset size. But for a smaller bank, this strategy is doable. And it's a lot of the expansion is focused outside London. And if you look at the total size, I mean, the UK commercial SME market is enormous. And so if you're talking about, like, in order to pick up incremental market share on where this is, I mean, you're really talking about, like, can they expand to sort of a 3 to 4% market share? And that would seem to be incredibly doable given the deposit franchise. So I think it passes the general sniff test. So the medium-term guidance for Metro prior to this slide that we're going to talk about was you move from a mid-single-digit ROE to, by 2027, you're approaching a mid to high-teen ROA. And from what we just sort of walked through, it would seem reasonably credible. I mean, they don't have to pick up that much incremental commercial market share. You've already had success. You already have a big chunk of the ROE pickup just from reinvesting treasuries, and the guidance that Metro gave was without any type of capital return. Well, this was an enormous event that happened last July. It's sort of part of the new UK government and the idea of making UK banks or making UK businesses more competitive. One of the areas that the government was looking at was making banks more competitive within the UK. And what they ended up doing was they moved the MREL threshold up from 15 for banks with assets of 15 to 25 to an asset size of 25 to 40 billion. And MREL, it rolls off the tongue, stands for minimum requirement for own funds and eligible liabilities. And maybe for U.S. investors, the easiest way to think about this, it's not an exact parallel, was think about the big banks with CFI requirements, significantly important financial institutions. And the idea is you want a layer of protection to protect the depositors in case a bank was ever taken over. The MREL ratio, the capital ratio, is essentially it's your common equity tier one. The most important metric for UK bank would be sort of your CET1 to your risk-weighted assets. So in Metro's case, the MREL ratio is essentially their total capital ratio, which is the CET1 plus tier two securities plus the senior debt that they have plus any AT1 securities. And you have sort of different levels of securities that sit above the equity that go all the way up to the senior bonds, which are the MREL bonds. And you add these all up, that's your total capital. We're looking at the ratio of that over to risk-weighted assets. Well, Metro is moving from, they're moving out of the MREL regime, if you will. So they're going to be a transfer firm, and this has happened. It was speculated with this move in July of last year it was going to happen. Metro said in their first half earnings call they're looking at this. They think they're likely going to be a transfer bank. It was confirmed in December, and so as of January 1st of this year, their new MREL capital level is 13.7%. And the current MREL is the prior capital ratio they had was 21.2%. So this means that Metro has 525 million of bonds, of MREL bonds, sitting out there at 12%. These were issued post that 2019 crisis. These are going to mature. They naturally mature in 2029. So the price of the bonds will move towards par value. It's highly likely that Metro is going to repurchase these. The bonds trade at roughly 115% of par value. I believe that they're going to tender for the bonds probably, I assume, June 30th of this year. I think it'll be sometime in 2026. They can do this from earnings and existing capital. There will not be new equity that is required to get rid of these bonds. That means 60 million of annual interest is going to go away. And this is a massive event, and it was not in the original guidance. And what's really interesting is Metro's bank stock has not really moved much since this was announced in July of last year. Now, part of it was concerns about the macro concerns with the UK budget. Those sort of came and went in November of last year. All the banks were pressured by this. Some of it is an existing malaise that exists among UK banks with concern about the macro risk, and some of it's just neglect. People aren't really looking at this, and others, I think that one thing that I found with European names in general is a lot of times the stock price reaction happens after something actually occurs. There is not a lot of anticipation that investors will grant companies. They want to see the bonds redeemed. They want to see the actual guidance reflect this new guidance, and then the stock moves. And this, as I sort of mentioned, this is again would distinguish Metro from other statistically cheap UK names. This is an incredibly hard catalyst that is happening. So putting all of this together, again, the original guidance for Metro is by 2027, they think they hit mid to upper teen return on tangible equity. The current ROTE in the first half of 2025 was 7%. We're going to get roughly 600 basis points, is slightly less than this, just from repricing treasuries. So just, the base rate's 3.75. Some people think, you may cut another 25 to 50 bips in the current cycle, absent sort of a steep recession. And in sort of this environment, the ROTE is going to move from 7% to a teen. The bank trades sort of around 75% of tangible book value. So I would argue just from this treasury repricing alone, the bank is undervalued at a low teen ROE. The asset rotation strategy adds another 2.5%, which again, we sort of say, I think it's very credible that they're going to be able to originate commercial mortgages based on what they've already sort of shown right now, the pipeline that they have, the small amount of mortgage market share. As you sort of see, it's not necessarily, it's not as large a driver of the ROEs as the treasury repricing is. The MREL call savings is a big one. I mean, it's another 4%, tight movement. And again, they haven't adjusted guidance, but you can sort of say, well, we can get up to sort of a 20% ROE before we return any capital. And then if we take this and sort of say, if a bank is generating, a high teen ROE, there is going to be excess capital returned. And sort of one way to think about it is, the MREL ratio, as I said, is 13.7%. The Metro has not given a CET1, the risk-weighted asset ratio. I assume that it's probably they're going to want to maintain something around 11.3, 11.5%. So as the returns come in over time, if we just sort of say, well, okay, anything above that sort of 11.3, 11.5% is returned as buybacks. If they were able to keep buying in stock at the current price, I mean, you could generate something close to a 25% ROE.